Welcome back to Morning Trade Live. It's time now for the big picture. So let's welcome in Collin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research. Good morning to you, Collin. Happy Friday. I put this to my last guest, but just talk us through what you make of the 10-year sub 4% right now.
Yeah, I think a lot of it's really stemming from private credit concerns and maybe some of the potential AI risks versus what the actual economic backdrop is telling us right now. If we look at the economy, we have inflation that's still a little bit too high, and that was kind of confirmed this morning with the PPI release. We have GDP that's still growing at or above 2%. You know, if we look at the GDP report from last week, the headline number was weak, but a lot of that was likely government shutdown related. Under the hood, look like the economy is still growing, and the labor market has stabilized. You know, it's not as strong as it was a couple of years ago, but it's stabilized. When you add all those together, we think we would likely see yields a little bit higher. But seeing that 10-year drop down to sub 4% for the first time since, I believe, November, I think that's really reflecting the fears in the private credit space to see if there is maybe some potential spillover effect. And if investors are looking to maybe dial back a little bit of their risky investments, that's when we tend to see that flight to quality trade. So I think that's probably the key driver, sending the 10-year Treasury yield sub 4%.
Okay, so a little bit of a flight to safety given some of the concerns out there in the market right now. When you talk about AI concerns, though, are you talking about some of the valuations, what we've heard around some of the demand there, or more so the funding, you know, sort of the debt to equity ratio, CDSs type conversation?
Yeah, for me, it's more of the funding issue. We've seen this huge boost in borrowing from, you know, issuers across the credit spectrum to fund their AI build-outs. And there, I'd say there's two risks there. One, will they get that money back, right? If they're borrowing now, are they going to earn that back in terms of cash flow or profits over these long periods? It's too early to tell. But also, when you see an increase in supply like that, is there enough demand to absorb that sort of issuance? And if the answer to that question is no, maybe you need to see yields adjust a little bit higher to attract that marginal buyer. It's the same type of thing we talk about with potential Treasury issuance. If we're going to be issuing more and more debt, is there a marginal buyer there? We might see that risk with credit if we continue to see the issuance that we've been seeing. Can the credit markets, are there enough investors and lenders to absorb that sort of increase in supply?
Yeah, it's interesting because the CoreWeave CEO, Michael Intrater, was here on the floor earlier today trying to address some of those worries, saying every dollar that they're putting to work today turns into dollars, plural, in 5 years' time. They say the backlog is enormous. So let's wait and see. We've got a lot of high-profile CEOs trying to obviously tamper some of those fears out there. But obviously we had Kathy Jones tweeting yesterday saying the private credit sector is finding a few more cockroaches. We wake up this morning with obviously Barclays down with some of its exposure to what's going on with a UK company. Just talk us through how you and your team are thinking about some of these worries and the cockroaches and, you know, as Jamie Dimon says, people doing dumb things right now.
Yeah, it's certainly making all the headlines right now, Sam. So when we think about cockroaches, that term really came out last October when there were two high-profile defaults and bankruptcies with First Brands and Tricolor Holdings, and it involved a little bit of fraud here and there, double pledges of collateral. But those are the risks we see when you see so much interest in markets like this. And we've seen such a boost in, you know, funds raised to lend to private creditors that we worry about the loss of price discovery, or do you bring down your lending standards? Now, when we look at the leveraged finance landscape, not all, you know, junk loan or bond investments are created equally. You know, we try to bucket them out. We have the high yield bond market, which I think a lot of individual investors are more comfortable with. It's something that's been around for a while. That tends to be a little bit more higher rated. High yield bonds, the index we track is 55% of it is double B rated, the highest rung of sub-investment grade. Then you have the publicly traded loan market that's lower rated than the high yield bond market. 75% of it is single B or lower. So we see more credit risk there. And then that third bucket, the more new bucket, especially for a lot of individual investors, is private credit. And that's probably as lowly rated as the public broadly syndicated loan market, or maybe even a little bit lower. I think a big risk there, though, and it's something that we're trying to figure out because it's private, you don't see the data, is deciding if this is a liquidity issue or a solvency issue. But if anything, it's kind of a wake-up call for investors that if there is a lack of liquidity, you can kind of see this volatility, and there are risks there.
Right, and obviously the latest episode is around some of the bridging lenders as well, obviously with the episode in the UK. Just very quickly, I mean, you touched on the hotter than expected PPI print this morning. Talk us through your thoughts as to how much of an impact that's going to have, obviously with the core at 0.8%. I was talking to KG at the top of the show. I mean, the jury's still out as to whether we see that pass through into the CPI, but something to keep an eye on. There's some base effects at work, but how are you thinking about that?
Yeah, it's certainly something to keep an eye on. When we look at the economic data, we think that inflation's in the driver's seat right now. We think most Fed officials are probably comfortable with the labor market, and it really will come down to inflation. And we know that there's a handful of hawkish members who want to see that come down, and this is going to make them a little bit more nervous. But even if the more dovish side, just a few months ago, we heard from Austin Goolsbee, who was relatively optimistic about maybe a decline in inflation that would, allow the Fed and him to support rate cuts down the road. But just yesterday, he said, unless we see that inflation come down, it's going to make rate cuts a little bit more difficult. I'm paraphrasing there. So this, I think, is probably going to give some officials some pause in terms of what are the next steps here. And this might mean maybe it's, a few more meetings before they're more comfortable cutting rates.
Okay, great stuff. Collin, thanks so much for getting us across your thoughts this morning. Have a wonderful weekend. We'll catch you next time. Collin Martin, Head of Fixed Income Research and Strategy, Schwab Center for Financial Research.